Hi, my name is Paul, and welcome to episode 15 of my monthly stock portfolio series, where I invest $100 every month into Canadian securities. Last month, I went over the first year's performance of my top gaining stock, and this month, both that company and the security that is currently my largest holding both reported their earnings. So, in this video, I'll briefly be highlighting the most important information and results that were shared with investors by the respective management teams. Though, if you do want a more detailed analysis of the earnings, I do already have in-depth quarterly analysis videos for both MTY Food Group and the Morguard North American Residential REIT, so feel free to check those out if you're interested. Anyway, in addition to summarizing my key takeaways from the quarterly results, I'll also be going through any other news that came up within the month, as well as comparing my portfolio against the benchmarks. Plus, I'll be showing you exactly where this month's $100 is going to be invested. But before getting to any of that, I just want to let you know that I do have a document that covers the goals and rules that I've set out for investing in the monthly portfolio. So if you're interested, you can access that in the description box for this video. Or you could always go back to the first episode of the series where I go over everything in detail. And a link to the series playlist starting at episode 1 is also in the description. Okay, so let's start with the Morguard North American Residential REIT, who released their earnings on the 14th. And I've got to say, this quarter was pretty strong. The REIT saw continued rent growth in both Canada and the US, and occupancies remained fairly stable across the portfolio, which of course had a positive impact on the funds from operations. Now, in my video on the report, I did forget to include a segment talking about the debt profile of the REIT. That said, the news here was by no means bad. Indebtedness dropped year over year by 2%, and while the average mortgage interest rate did increase, all of these loans are at fixed rates, and currently are well below the federal level. Plus, the maturity dates on these loans are right in line with what we should expect. Now, unfortunately, the tangible book value per share did decrease this quarter on account of the softening real estate market, which of course led to lower appraised values on the REIT's properties. That said, this drop was expected to happen for a while now, and it probably will continue to happen into the future. On the more positive side of things, the REIT did acquire the remaining 50% of the Fenestra building in Maryland for a very reasonable $105 million, which means that the REIT now has complete control over the building as well as the adjoining retail property. And the good news doesn't end there. On the conference call, the REIT announced that they've begun repurchasing shares and that they plan to continue to do so in order to achieve a share price that's in line with the net asset value, which for the most part is the same thing as the tangible book value per share. This would mean that the REIT's shares, currently trading in the mid-$18 range, can be expected to approach the underlying value of the net assets, which on a per-share basis is just shy of $45. That said, this $45 figure is dependent on the appraised property values remaining constant, which is not something that I'm expecting to happen. But even if the value on these properties drop a further 25% into the mid-30s, there would still be share price appreciation of 100% if buybacks continue until there's no discrepancy between share price and the tangible book value per share. Finally, we got a bit of insight into what the management sees going forwards in the real estate landscape. In Canada, rents are expected to continue increasing due to the implemented rent control policies within Ontario that have been suppressing normal market pricing. Meanwhile, in the US, the recent explosive AMR growth is expected to slow down due to federal interest rate hikes and declining home prices, which is diverting demand from rentals. That said, the management does not expect rents to decline. They just think that the rent growth will slow down to a more normal pace than has been going on in recent quarters. And that's about all there was for Morguard's earnings, but there was a bit of news after the fact regarding the 4.5% convertible debentures, and each debenture will be officially redeemed by the REIT on March 24th for their fair cash value. And on top of that, the REIT is also offering a new series of convertible debentures at a 6% interest rate. Though this time around, the principal will be $50 million as opposed to the 2018 series, which had an issuance worth $85.5 million. Also, the conversion rate will be increasing from $20.20 to $24.15 per debenture. And these new 2023 debentures will be set to mature on March 31st of 2028. So, in its essence, this is just a revolution of convertible debt instruments, which isn't going to change much of anything for the majority of shareholders. Next, we have to get into MTY, since Knight Therapeutics once again had virtually nothing newsworthy come out within the month. Now, unlike Morguard, MTY's quarter was a bit more concerning, and it was also a bit more difficult to parse, since this was the first quarter with Barbecue Holdings contributing to operations, and that of course messed with all of the quarterly growth comparisons. This issue materialized itself most obviously in the 688% quarterly revenue gain coming from US corporate stores. Now, I went into this quarter's earnings fully expecting debt levels to have skyrocketed, and they definitely did. See, this long-term debt figure here highlighted in red isn't the extent of things, because the Wetzel's Pretzels acquisition technically happened subsequent to the quarter's end and is not included. So we can pretty safely assume that another $280 or so million will be added on here. Plus, all of that borrowed money is floating rate debt. So if interest rates keep rising the way that they have been, then the interest expenses owed on that debt will also rise. In worse news, the existing net location closures came in a fair amount worse than expected. And if it weren't for the 300 acquired stores, thanks to the Barbecue Holdings deal, there would have been a net loss of 118 restaurants in the quarter. As for the cherry on top, supply chain challenges have persisted and costs have risen. Plus, short-term headwinds appear as though they will keep getting at least a little bit worse before they get better, with planned minimum wage increases in some geographies set to take place within the year. Thankfully, that's where the bad news ends, and despite all of that negativity, there were still some positive things to take away. Firstly, the free cash flow per share held up quite well considering the acquisition-related costs that I had expected to take a larger toll. Also, the recent Barbecue Holdings acquisition appears to be performing incredibly well, with MTY's management mentioning on the conference call that they were able to increase prices without having any negative impact on customer traffic. To conclude, the management is well aware of the issues at hand, and they're working to get ahead of things by prioritizing the success of existing concepts, paying off debt, and taking advantage of quality acquisition opportunities when they present themselves. So, not all bad, and based on the information we currently have, I think that things are going to turn out alright. Also, if you didn't happen to watch my more detailed video covering this quarter's results, then I will fill you in that the Grocery Collection website that I'd previously been using to track MTY's retail products was practically proven not to contain the full catalog of MTY's retail products on offer. So from now on, for the most part, I'll probably just be following the numbers as they get reported in the quarterly reports, though I will give any updates if there are big moves that happen on the Grocery Collection website. And there was no other news out of MTY this month, so let's get into how the portfolio performed throughout February. At the start of last month, I deposited $100 of cash into my Wealthsimple account, and I received $3.12 in distributions from Morguard. So I took that $103.12 and I invested every last penny into 4 shares of the Morguard North American Residential REIT, 3 shares of Knight Therapeutics, and 0.179 shares of MTY Food Group. Unfortunately, the best performing holding this month did decline by about 1.45%, but this was Morguard, which is the largest holding, so at least the total outcome can only be so bad. Nonetheless, the REIT's unit price dropped from $18.62 to $18.35. Next was Knight Therapeutics, whose shares declined by 4.31%, dropping down from $5.34 to $5.11 per share. Finally, the worst performer for the month was MTY Food Group, who after the previous month's big run-up came back down a little bit, shedding 5.22%, which took share prices from $70.69 to exactly $67 as of the market's close on Thursday, March the 2nd, 2023. Now, you'd think that all of my holdings dropping in share price would result in a loss for the month. But if we account for the dividends received from Morguard and MTY, the $103.12 that were invested actually managed to appreciate to $104.99, which is a gain of about 1.8%. Without the dividends though, there would have been an unrealized net loss of 2.33% for the month of February. Taking a look at the entire portfolio, since inception, the total market value is sitting at $1,520.11, which is a gain of 7.03%, or about $100 on the $1,420 of capital invested. So I'd say things are going pretty well, but let's take a look at how my portfolio compares with the benchmark ETFs. Well, for starters, none of the benchmark ETFs received a dividend within the month of February, and this made it so that my portfolio managed to outperform. That said, without my earned dividends, my portfolio would have been the worst performer, slightly trailing the S&P 500, which put up a 2.13% decline. Meanwhile, the Canadian All-Cap ETF and the Canadian Large Cap ETF also had declines of 1.53% and 1.81% respectively, while the Global Value ETF led the benchmarks with a drop of 0.64%. Taking a look at the total comparative performances net of contribution, we can see that my portfolio fell relatively in line with the benchmarks. However, the Global Value ETF continues to hold up incredibly well. On that note, while I have been enjoying the tough competition, I still fully intend to surpass the Global Value ETF and reclaim the top spot in the future. Now, last month I completely neglected to mention that I had officially surpassed the red goal line, which represents a compounding 12% annualized rate of return on contributed capital. And despite this month's decline, I am still holding well above the goal line, which is really nice to see. However, I do suspect that there will be future months where I find myself underperforming the goal, and that variance is just part of investing. Sometimes I'll probably find myself well ahead, and other times I'll probably be a bit behind. But overall, I think the most important thing is just to focus on making the best possible decisions that I have available to me at the given moment. That said, concerning this month's capital, I do have some decisions to make, and before I make them, I do want to touch a little bit more on what I talked about in my quarterly analysis video for MTY. In the video, I said that given the current economic headwinds, acquisition-related variable rate debt, and increasing federal funds rate, I don't think that I'd be willing to pay more than a price to free cash flow of around 13 for MTY's stock. Currently, the price to free cash flow is right around 12, so there isn't a huge margin of safety there. Shortly after posting this video, I received a couple of really good questions from Zam, who has practically been around since the beginning of the channel. And these questions got me to consider comparing the operating valuations and share price for both Morguard and MTY over the past year. Thinking about both of these securities in this light really helped to put into perspective that while Morguard's discount to fair value has improved by almost every single metric over the course of the year, MTY's discount has only continued to shrink. Now, to be fair, MTY is still going to be experiencing the effects of the two recent large acquisitions, so it might be a bit early to judge. But for the most part, MTY's existing business has been, by all accounts, underperforming its recent share price run-up, such that comparing it to last year, the free cash flows are practically the same, existing franchises have continued to experience net closures, costs are continuing to grow, and now there's a bunch of additional floating rate debt at the highest interest rates we've seen in over a decade. Yet, in spite of all of that, the stock is up over 30% in the last year. Now, I'm not trying to give you the impression that MTY shares don't deserve the $67 price tag that they currently have. After all, it was very heavily discounted when it was trading in the 40s and 50s. That said, the discount at the current price point appears to be much smaller, and while it is still very possible for the company to perform better and achieve higher multiples on its shares, I'm certainly not going to invest with the expectation of that happening. So the risk-reward situation has definitely been changing. Unfortunately, I don't have any other company that I'm looking to pull the trigger on yet, though I have pinpointed 3 companies that look very promising. Sadly, 2 of those 3 companies don't meet the market cap requirement for the portfolio, but the third might just make it into next month's buys. For this month though, I think I'll just stick to buying my usual MTY shares, since there is still a little bit of space between the current share price and my conservatively estimated fair value for the shares. So for this month, the plan is to pick up 4 shares of Morguard, 3 shares of Knight Therapeutics, and the remainder will go into MTY Food Group, as per usual. Alright, here I am inside of the account. I have $104.27 to invest, so let's get started. First, we're going to go to Morguard. We're looking to buy 4 shares. Then we're going to go over to Knight Therapeutics, buy 3 of those. And lastly, we're going to spend our $14.53 on a fractional share of MTY. And I'll see you in just a moment once that comes through. Okay, I'm back and I have officially received 4 shares of Morguard for $18.55 each, 3 shares of Knight Therapeutics for $5.18 each, and 0.216 shares of MTY Food Group with a cost basis of $67.29 per whole share. So, as of the market's close on Friday, March the 3rd, the portfolio holds 64 shares of Morguard worth about $1,178, roughly 4 shares of MTY Food Group worth nearly $271, and 34 shares of Knight Therapeutics worth a bit over $174. And yet again, there was no cash left over after investing this month's capital. Transitioning into the dividend tracking segment, February was a giant step up in monthly dividends received, achieving a new monthly record of $4.27, which is the first time the portfolio has earned a full dollar more in dividends than in the previous month. And this record was partially thanks to MTY's steep dividend hike, but the majority of the earned dividends for the month still came from the Morguard North American Residential REIT, which paid out $3.36. And this month's dividend income is actually enough to buy one of these brand name sticks of deodorant. So now we can smell as fresh as the ocean breeze in Belize. And while the portfolio is probably a decade or more away from a dividend-funded tropical vacation, one day we will get there. But until then, we'll just have to find contentedness in our discounted deodorant. As for next month, the portfolio's dividend income is expected to drop down to $3.60, since MTY only pays its dividend out quarterly. So, in March, I'm only expecting to receive a payout from Morguard. As for the cumulative dividends earned, since inception, the portfolio has now received $24.50 in dividends, and that's almost a quarter of my monthly $100 contribution right there. Now, if I were to just leave the portfolio as it is and collect the dividends in cash, assuming no changes were made over the next 12 months, I could expect to receive $50.20. This is more than half of a full month's contribution money, and it represents an increase of over 6.5% from last month's expected yield. So, as of right now, my portfolio has a yield on contributed capital of 3.34%. And before I go, I have to say that watching these numbers grow over time has been oddly very satisfying. So if you're someone who's considering setting up a spreadsheet to track your own dividend income over time, I'd highly recommend it. With that, I'm going to leave things where they are until next time. But before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who might also benefit from it. Thanks for watching all the way to the end, and enjoy the rest of your day.